Let's turn to the economy. Some positive signs continuing this week, with experts saying the robust holiday shopping season is an indicator the economy is in a better place than most experts had expected. Overall, widespread fears of a recession in 2023 did not happen. As for next year, according to a recent survey by the National Association for Business Economics, more than 3/4 of economists say the chances of a recession in 2024 are 50% or less. Let's bring in business and finance editor at Semafor, Liz Hoffman. Her new piece features predictions for 2024 from financial experts. It's titled More Bank Failures, Suburban Offices, and a Lot Less Hype. Also with us for this discussion is Rich Lesser. He's the global chair of Boston Consulting Group, an organization that helps businesses improve their financial performance. Good morning to you both. Liz, I'll start with you and some of what you heard in talking to experts there about the economy. Consumer spending was strong around the holidays, has been. Consumer confidence is up, inflation ticking down. What did you hear about 2024 as you asked around?
Yeah, you're right. This has been kind of the longest predicted recession that has yet to show up, and sort of increasingly looks like it won't. The U.S. economy is really driven more so than many developed economies by consumer spending, and it's been incredibly resilient. The excess savings from the pandemic, about $2.5 trillion, and experts kept predicting eventually that's got to get spent down, and you'll get to the bottom of the wallet, and that'll just, that'll be where the economy kind of falls off a cliff. And it hasn't happened. There are still some real concerns, particularly around the cost of borrowing, which, we can talk about interest rates, is going to remain high for a significant period of time. Most U.S. households, kind of like the government, run a deficit, and they plug that gap between spending and money coming in by borrowing, and that's going to remain pretty expensive for the foreseeable future.
So, Rich, as you look at just the data, if you look at consumer spending, you look at growth, the GDP, as you look at inflation ticking down, gas prices coming down, all the things we look at as economic indicators, what's your outlook for 2024 and the experts you speak with?
I think a year ago, we were more on the optimistic side. That was not the conventional wisdom, but we thought there was a real chance for a soft landing. I think now that we've come a year in, I think we remain more on the optimistic side looking ahead. I won't repeat all the statistics you just cited, but they're very encouraging ones. I do think we all have to bring a lot of humility to this. I mean, the amount of uncertainty that the economy, that businesses have faced over the last 4 years has been enormous. So I think if you're a business leader looking ahead, I would call it uncertainty tinged with optimism. Whereas I think a year ago, you'd have gone into the year saying it's uncertainty, but with a whole lot of pessimism around it. And I think that is a meaningful change. We'll have to see how it plays out. Just as in the prior years, there were a lot of wild cards, whether it was supply chains or inflations or wars, let alone the pandemic. There's been a lot thrown at us. Hopefully this year, we know the political side will bring some uncertainty for sure. So we'll see how that plays out. But I would lean, and I think many businesses are starting to realize that the optimistic case has more likelihood to play out.
Yeah, certainly a rosier outlook would look good for a president running for re-election. Liz, let's talk about some of the predictions that you folks at Semafor have gathered from some top business minds. Two in particular I want to touch on. Mark Dixon suggested that hybrid work is really here to stay, and frankly a trend that could accelerate, which would, I'll note, have real impact for urban centers, which are already battling commercial buildings with a lot of vacancies and the impact that has. And then secondly, this idea from Sheila Bair, from former head of the FDIC, there could be additional bank failures. We had a few at the beginning of 2023, and then it seemed to stabilize. But take on those two. Expand about what these two mean.
Yeah, and they're related to each other. So, there's $5.5 trillion of commercial mortgages out there, and about half of them sit at banks, mostly these mid-sized regional banks, which are huge office and property lenders. And so you're seeing two things really happen there. One is, to your point, we're in Midtown Manhattan today. Big office towers here on a good day, 50% full. And you haven't really seen the effect of that coming through post-2020 because leases are long and it takes companies a while to either get out of them or figure out kind of how much space they're going to need. You are going to start seeing that, and big tenants are going to say, I don't need this much space. or I want a massive reduction in rent. So these landlords are going to get squeezed on the revenue side. And then, as we talked about earlier, debt is getting incredibly expensive. And you have $1 trillion and a half of real estate mortgages, commercial property loans that have to get refinanced in the next year or two. And that's going to be massively expensive. So I think you're going to see some real pain in the commercial property sector. And again, a lot of that sits at these mid-sized banks. We have not, in my opinion, and don't take my word for it, Sheila Bair ran the FDIC for many years. We have not seen the last smaller mid-sized bank to go under. I think we've moved from this kind of acute, you remember these weekends from the spring, Silicon Valley Bank, First Republic getting seized over a weekend, very messy. We've moved from this kind of acute liquidity problem at these banks where they just don't have enough cash to meet their withdrawals to this kind of slower moving earnings problem. You have these zombie banks out there where they're now having to pay up for deposits, which they didn't have to do before. And they're having these loan problems where loans are going bad, fewer new loans being written at more profitable rates, and they're just getting massively squeezed. And you're going to see some real problems there.
So let's do two more quick ones. I'm contractually obligated to mention Anthony Scaramucci. He's very bullish on Bitcoin. You can dispatch that quickly if you'd like. I'm actually more interested in what Sharon Block, former Biden administration official, has to say about the rise of unions, which we saw. Unions had a huge year in 2023. Auto workers, just one of them. She goes so far as to say that Tesla may be unionized at this time next year.
Yeah, that was actually the most interesting prediction to me. You know, you saw, again, we had the auto workers, UPS had a big contract come up. Hollywood, obviously. And some of that's just sort of the luck of the calendar, right? These things came up in the same year. But, you know, workers are looking around saying, actually, unions are actually getting things for their members. We should think about it. And so what Sharon's saying is you're going to see fewer big new contracts get negotiated, but actually the momentum is going to move towards organizing places that are not organized. And the obvious places to start are the non-unionized auto workers. You saw, I think, Hyundai and Honda, maybe Toyota very quickly gave wage increases right after the UAW, got the big ones from GM, Fiat, and Ford. And Tesla is an obvious place to start. I mean, the safety record there is not particularly good. This is, unique, particularly among Elon Musk's companies. I'm not sure that people go work at Tesla because they believe in Elon Musk in the same way they might at SpaceX or other places that are a little more ideologically driven. These are people on assembly lines that are pretty dangerous and that have not gotten, significant market wage increases in a while.
Hey, Rich, let me ask you about another important factor to the American economy, and that is the housing market. It is just brutal out there right now and has been for over a year, whether you're looking to buy a house at rates at 8% or sell a house at 8%, which you presumably are looking to buy one after that as well. It's just a bad time to do either. So do you look for that to change in 2024?
I do. Partly because I think that the Fed has largely succeeded on the fight against inflation. And I tend to believe that over the course of this year, we'll see interest rates start to fall. That'll create some renewed optimism in the housing market. We didn't see prices crash because we're in a housing shortage. And I think that that will bring some liquidity back into the housing market. If you said predict the first quarter, I'm not sure we'll see much change. But I think over the course of this year, I would be on the more optimistic side because I think the Fed's going to realize that they don't need to hold rates as high as they're holding them over the course of this coming year to stay in the roughly 2% range. Maybe not 2.00, but in roughly 2% land. I think that they'll have some freedom to act, and I suspect by the second, third quarter this year, they'll have the confidence to do that.
We will see. Let's hope so. It's tough out there. Global Chair of Boston Consulting Group, Rich Lesser, and Business and Finance Editor at Semafor, Liz Hoffman. Thanks so much, both. We appreciate it. So